Hello investors and future investors, welcome to the channel. In this video, I will show you a 4-leg option strategy that will allow you to make weekly revenue if used correctly. If you're new to the channel, thanks for stopping by. For those of you on the weekly income team, welcome back. On this channel, we help you with option strategies that can give you consistent revenue and everything related to finance and investments. Welcome to Investment Gains. Let's jump right into it. So today's option strategy can be used when the market is flat and trading sideways, or I personally use this strategy during earnings. This strategy is the Iron Condor and is a 4-leg strategy that involves a combination of a put credit spread and a call credit spread. If you're not familiar with these options, I will link them in the video above. So you have a choice to watch them and then come back to this video. However, it is possible to understand an Iron Condor without looking at those videos. I will try to make it as simple as I can. So for today's example, we're going to be using CCL or Carnival Cruise Lines. So the first thing we want to do, we want to go into the options chain, and to get there, we go to trade CCL options. So let's get started with this Iron Condor. So we go to trade CCL options. First of all, we're going to choose our strike date and we're going to go to June 4th, which is about 1 week out. Next, we're going to do our puts first. Of course, you can do your calls first. I just like doing my puts first. So we're going to be selling a put at a 28 strike price. And for selling this put, we're going to receive 0.55 or $55. Now we're going to go over to buy and put, and we're going to be buying the put below our self put for 27.5. And for buying this put, we're going to have to pay 0.38. Now, as you can see, it says put credit spread. Robinhood tells you exactly what trade you're performing. So that's done. So now we're going to go over to the call side of this Iron Condor. So we're going to be buying our call first. We're going to buy the call at 29.5. And for buying this call, we have to pay 0.46 or $46. Then we're going to go over to our sell call. And we're going to sell the call at $29. And for selling this call, we're going to receive 0.63. Now, as you can see, it says Iron Condor. If it says anything else, you're doing it wrong, just go back and do it once again. So we're going to go over to continue. Then, as usual, we select the amount of contracts we want, which is usually 1. And we hit review. And there you have it. So now I'm actually going to break down this trade for you. So in order to perform this Iron Condor, Robinhood is going to give us $35 minimum credit right away. That goes into our Robinhood buying power, and that is ours no matter how this trade goes. In order to perform this Iron Condor, we will be required to leave a collateral of $50. Once you win this trade, you're going to keep your $35 minimum credit, and you're also going to get your collateral released back to you. Now, your maximum loss on this trade is going to be the difference between your collateral and your minimum credit. So 50 minus the $35, which is 15. So $15 is going to represent your maximum loss. Now, if this is not a good trade, and I do not know what a good trade is, you're actually paying you're risking $15 to make $35. Okay, so down here it actually says what we did. So we sold to open at 28, we bought to open at 27.5, then we bought to open at 29.5, and we sold to open at 29. Now, it's like I said, if you look at it that way, it's going to be pretty confusing. The easiest way to see an Iron Condor is as a combination of 2 spreads, a put credit spread and a call credit spread. So if you want to practice your Iron Condor, just keep doing the 2 spreads, and then when you feel confident, just put them together. So how do you win with the Iron Condor? Well, with the Iron Condor, at expiration of June 4th, you want the share price to be trading between at 29.5 and your put at 27.5. Once the share price end up anywhere between that sell call and that buy put, then you get your maximum gain. Now, how do you lose the Iron Condor? Any price outside of 29.5 or below 27.5, then you lose the trade and you lose your $15. So what that means is that your collateral will be kept, but remember, initially you received $35. So your maximum loss there becomes $15. So why would you want to use an Iron Condor? Well, ideally you want to use an Iron Condor whenever the market is trading flat. Iron Condor are best used on most ETFs since they don't have huge price movements. I personally love using Iron Condors during earnings. And the reason why I do that is because price movement is already priced into the options price during earnings. Now, most newbies do not know that and they lose a lot of money during earnings. Okay, so let's just review this one more time. Let's go to trade CCL options. We're going to choose our strike date, June 4th. So we're going to sell our put. Then we're going to go over and then we're going to buy a put below our sell put. Then you're going to go over to call. You're going to buy your call. Then you're going to go over to sell. And then you're going to sell a call. And there you have it, Iron Condor. Just a word of caution. Please choose a stock that you know has a history of trading sideways. The idea, as always, is to continue to generate weekly revenue to help grow your account. Now, we have lots of strategies like this on this channel. So if you want to join the weekly income team, like and subscribe right now. Also, hit the notification bell to get an alert whenever I post a video. But most importantly, if there's anyone you know that can benefit from this video, please share it with them. Let's help as many as we can. Thanks for watching, and always remember, always take your investment gains.